Okay. Good evening, my host. Can you confirm that you can hear me or you can see my screen? My host. Can you see my screen? Hello?
Yeah, we can see your screen and we can hear you, sir.
Oh, all right, thank you. Okay, good evening, all. Welcome to week 2 of our tax class on this platform. Last week, we looked at stamp duty and value added tax. Today, we are going to look at the process of return procedure, assessment procedure, and collection procedure. So it's return, assessment, and collection procedure. That is what we are going to look at today. Before we take question, we look at the topic briefly to see the requirement, then we now go to questions where we see how we are going to apply what we have learned to answer the questions. That is the approach we are going to adopt for today. So I want to believe that we have gone through the previous notes and you have understood it very well. Like I told you last week that you are going to be examined based on the Finance Act. So everything we are doing on this platform is Finance Act compliant, okay? It's Finance Act compliant. So let's go to the business of the day. Return, assessment, and collection procedure. We take them one by one. Return. Okay. So under the return, we have requirements in the tax law that says that every taxpayer must register for the purpose of tax remittances. Okay? So every corporate entity is expected to register with Federal Inland Revenue Service for the purpose of payment of necessary taxes. Okay? So what are the requirements for for registration and filing of tax return? What are the requirements? Now, the student is off. Let me wait for him to join before we continue. Okay, so every corporate entities, okay, every corporate entity is required to have what we call a TIN number. TIN means tax identification number. So tax identification number is unique to every corporate organization. So for you to I've said to have registered for tax purpose, you must have your TIN. So every company must have a TIN number. Then, in addition to having a TIN number, all companies, okay, is required to display the tax identification number on all invoices. When you are issuing out your invoices, your tax identification number is expected to be stated on your invoice. Even ministries, extra-ministerial departments are required to have what? To have their TIN, okay? Must have their TIN. Are we together? Then we have special requirements for banks. There was a requirement when the Finance Act 2019 came into existence that banks should mandate all its existing customers to register for the purpose of collection of tax identification number. Okay. While for new customers that are registering or that are opening an account for the first time, the requirement for opening account is that you have your TIN number ready. So account will not be open for customers that do not have TIN number. I want to get to corporate entities. These are the three reasons why a company should have a TIN number. Every company must register for the purpose of obtaining TIN. And number two is that on your invoice, we expect that your TIN number is displayed. And if you operate bank or banking, you carry out banking operations, you are to mandate your customers, your existing customers before the Finance Act came into existence, to go and register for VAT and show you evidence of registration. They provide you the TIN, then for the purpose of you updating their account. And for new customers, their TIN number must be supplied at the point of opening new account for them. That is for the registration for the purpose of tax identification number. Now, nature of tax return. Okay, every company is expected to register with Federal Inland Revenue Service for the purpose of tax remittances. Okay, now, when you register for the purpose of tax remittances, it means on an annual basis or otherwise as the nature of the business may require or as the Federal Inland Revenue Service may demand, you are expected to file your return. Okay, you are expected to file your return. For instance, if your account year end is December, at the end of December, the FIRS is expecting that you come and file your return for the year just ended. Are we together? So, what are the contents of that return you are filing to FIRS? Please take note. When you are filing your return to FIRS, what are the contents of the return you are filing? Number one, we have what we call the self-assessment return in the prescribed form. We are going to treat self-assessment separately. Okay, for now, just know that part of what you are submitting is self-assessment. But briefly, self-assessment simply means you are assessing yourself to tax purpose. By yourself, you are determining your own tax obligation. Okay, if I'm computing my tax obligation by myself, we call it self-assessment. So government is not coming to say, oh, this is the tax you are going to pay. Rather, I am computing my own tax liability by myself. That is what we call self-assessment. And like I said, we're going to look at self-assessment in a later session of our discussion, okay? Then your audited account is also required as part of the content of the return you are filing to FIRS, okay? Your audited account is needed as second. Then your tax computation, the tax you are paying, the basis upon which you have arrived at that figure is expected to be submitted alongside the return you are filing, okay? Then you also have, in addition to tax computation, you have computation of tax allowances or schedule of tax, capital allowances, rather, schedule of capital allowances. So capital allowances are computed as an allowable to arrive at your chargeable income. So the basis of the capital allowance you have charged or you have deducted from your revenue is expected to form part of your return where you are filing with Federal Inland Revenue Service. Then you must also attach evidence of payment of the tax due. Okay, evidence that, oh, I have paid my tax. You have to attach it as part of the return. So making 4 components. When we say return, it therefore means that return has 4 components. 1, self-assessment form, duly filled. 2, your audited account. 3, tax computation and schedule of capital allowances. And 4, the evidence of payment of the tax due. Okay, the evidence of the payment of the tax due. These are the 4 content of your return to the Federal Inland Revenue Service. So we have looked at 2 things now. 1, registration for the purpose of collection of tax. 2, the content of the return you are submitting to FIRS. The content of the return you are submitting to FIRS. Okay. So let's move on. The section 55 subsection A of Company Income Tax Act, as amended, provide that where a non-resident company derives profit or is taxable in Nigeria under section 12 of the Act, such company shall be required to submit a return to relevant for the relevant year of assessment. What are we saying here? This section is looking at who is expected to file returns. Who is expected to file returns? So if I am an incorporated entity and I am a resident company in Nigeria, okay? I'm a resident company in Nigeria. It is expected that I file my return, okay? It is expected that I file my return for a given year of assessment. That's one. Resident entities are required to file return with the Federal Inland Revenue Service. Then the company will submit a full audited financial statement. Okay. And all what we have mentioned in section in the preceding session, we have to be filed along. Then what about a non-resident company? You may have a non-resident company that is having a kind of operation in Nigeria, or is having what we call significant economic presence in Nigeria. Now, by significant economic presence, Finance Act 2019 does not define what is meant by significant economic presence. Rather, it leaves that in the hand of the Minister of Finance to determine what constitutes a significant economic presence. But once a company has been, a foreign company, a non-resident company, has been judged to be having a significant economic presence in Nigeria, then such a company is expected to file its annual return. And what type of return the company will file rather? The company is going to file two sets of financial statements. You know, the company is not resident in Nigeria, but is carrying out some businesses in Nigeria. It therefore means that it will also be carrying out businesses in other countries as well. So for the purpose of filing annual return with FRS here in Nigeria, the company is expected to file the global financial statement. The global financial statement is the financial statement that contains the result of its global operations. Okay, the report or the financial statement that contains the financial result of all its global operations. The second set of accounts is the one that is now specific to the Nigerian operation. What we are deriving from Nigeria, what account is attributed to that? Okay, so these are the two sets of financial statements that is expected to be filed by a non-resident company that is having a significant economic presence here in Nigeria. Okay, so we have explained this one earlier, self-assessment, okay, duly computed income tax self-assessment form. So we explained all those ones earlier. So resident companies and non-resident company may be required to file return depending on the circumstance in which the company is operating. So what is the time limit for which a corporate entity is expected to register for tax? What is the time limit? When a company commences operation, okay, it is expected that the company will register for tax purpose immediately, okay, or within 6 months of commencement. Either as you commence, you are registering for tax purpose, or if you cannot register immediately, then within 6 months of commencement of operation, a company is expected to register for the purpose of tax. Now, by commencement, what we mean is that if you are a merchandising company, that is, you are into buying and selling of goods, the first day you make your first sales is your day of commencement. Or the first day you purchase the product for the sale, it's also significant the fact that you have commenced operation. Okay, if you are a service-oriented entity, the first day you render your service to a client is the day of your commencement. Okay, is the day of your commencement. So upon commencement of business, an entity is required to register for the purpose of taxes. Then, what is the registration requirement and processes? Okay, what's the registration requirement and processes? For you to register for tax, the process is that you are registering for two types of taxes: income tax and value added tax. Income tax and value added tax. As per the income tax, you have what you call questionnaire to fill. The questionnaire will ask you questions such as the name of your company, the registered address, the address for which the company will be operating, the name of first directors of the company, the shareholding structure, okay, name of bankers, name of statutory auditors. These are questions that you need to answer on the questionnaire for the purpose of income tax. Okay, so the second form that you are supposed to fill and submit is the VAT form 002 or 00201. Okay, that is VAT registration form. I think it should be here in Zoom. Okay, you can see what I'm talking about this, about registration for CIT. You can see these are the requirements: register of the business address, precise of business, and so on and so forth. So you have many of them. You are not expected to cram all of this, but just try to cram if it is as little as 5 or 4. Okay. What about registration for VAT? For registration for VAT is VAT form 001. VAT form 002 is for filing of monthly VAT return. Filing of monthly VAT return. For registration for the purpose of VAT, you are using VAT form 001. But when you are remitting your VAT, you make use of VAT form 002. Okay? And you need certificate of incorporation as well. These two, income tax and value added tax, are registered for simultaneously. Not that you register one today, you are registering the other one another day. It is registered concurrently in this regard. Now, that is requirement for registration for the purpose of collection of taxes. Let me know whether you have a question. Question? Type in your question. Excuse me, let me take water. Just give me like 30 seconds. Okay. So if you have question, kindly drop your question before we continue. Pelumi, Daniel, your question on what we have discussed so far on return assessment and collection procedure. None for now. Okay, thank you. Pelumi, what about you? Are you fine as well? Oluwa Pelumi. Okay, let us continue. Let us continue. Now, we go straight to content of a tax return. Content of a tax return. Content of tax, though we have said that briefly there. This, when we say tax return, what are the contents. 1, audited financial statements. Audited financial statement. 2, income tax and capital allowance computation. 3, completed copy of company income tax form IR3C for COI company. Then completed copy of tertiary education tax, which is form 4D EDT. The evidence of payment of company income tax liability. These are the content of your tax return. These are the content of your tax return. Audited financial statement, income tax and capital allowance computation, completed copy of company income tax form, completed copy of tertiary education tax, and evidence of payment of income tax liability. Now, your income tax liability, okay, and evidence of payment of tertiary education tax as well. Your income tax liability can be paid by installment, which we are going to see in the later section. You can apply for installmental payment of your company income tax so that your payment is spread over a maximum number of 3 installments. We are still going to look at that.
Yeah.
1 minute, please. Okay. So these are the content of tax return. Okay, these are the content of tax return. Okay. So what is the due date for filing of your return? What is the due date for filing of tax return? It is expected that a company that is in operation for more than 18 months, okay, should file its tax return at most 6 months after the end of each accounting year. If you are already in operation for 18 months, you are already in operation for 18 months, it means you are categorized as an existing company. So an existing company is expected to file its annual return on or before 6 months after the end of each accounting year. However, in the case of a newly incorporated company, the due date for filing of tax return is within 18 months from the date of incorporation and no later than what? 6 months after the end of its first accounting period. I repeat, for an existing company is a company that is already in operation for a period of above 18 months. And for such a company, the return should be filed within 6 months after the end of its accounting year. That is the requirement. But for a company that is newly incorporated, a newly incorporated company is a company that is in operation within 18 months. So if you are a new company, your first return is due within 18 months of your what? Of your incorporation, or 6 months after the end of the first accounting year end, whichever is earlier, that is, whichever comes first. That is the requirement. Now, What about when you file your return? What is the time limit for you to pay the associated tax on that return? Now, the requirement is the fact that as you are filing your annual return, we expect that you pay the amount of tax due on that return. However, you have an option to apply for installmental payment of tax. So if I'm filing my return, I can apply that, oh, I want to pay my taxes in 3 installments. So the installment cannot be more than 3. And there are conditions for you to be entitled to the installmental payment of tax. The condition is, number 1, is that you must have applied for installmental payment of taxes within, before the filing of your annual return, that is within 6 months of the filing of your annual return. This means that it is not on the date you are filing your return that you now be applying for installmental payment of taxes. No. If my accounting year end, for instance, is December 31, so between December 31 and June 30th, if I want to apply for installmental payment of tax, my application must have been sent to the Federal Inland Revenue Service in that regard. Okay. Now, if I want to apply for installmental payment of tax, number 1, like I said, is what? You have to apply early enough before your filing deadline, 2 is that the application must be submitted alongside the payment of the first installment. Okay, application must be submitted alongside the payment of what? The first installment. And of course, the installment cannot be more than what? Cannot be more than, installment cannot be more than 3. Okay. Now, the payment for tax can be categorized into 2. We have an assessment that is served upon you by the Federal Inland Revenue Service, and we have a self-assessment. We have discussed briefly self-assessment, but we are going to see it in detail later. But if your assessment is self-assessment, it means you are computing your tax liability by yourself. So you are paying your taxes within 30 days. But like I said earlier, you can apply for installmental payment of taxes. But if it is an assessment raised by FIRS against your company, an assessment raised by FIRS can be categorized in so many forms, which we are going to see. You can have BOJ, you can have administrative assessment, you can have back duty assessment. We have various categories of them. Whichever one it is, you are expected to make the payment within 30 days of receiving that assessment. Okay, but if the 30 days, okay, lapses on the last day of the year in which that assessment relates, then the settlement of the amount due is expected to be paid on the last day. Or that what? Sorry, on the 14th day of December, not last day, on the 14th day of December of that year that the assessment relates. Let me give you an instance. Let me say FIRS served me an assessment of 2 million naira and the assessment was served on the 30th of November 2021, meaning that I am expected to make my payment within 30 days, right? But if you look at it, the 30 days will expire after 31st of December 2021. And the requirement of the law is that if the time limit for the payment of the assessment will expire after the 14th of December of the year that the assessment relates, then the amount of the assessment is payable on the 14th day of December. I believe that is clear. That is what I'm trying to explain here. Is that clear? Or do you have any question? Any question? All right, let us continue. What are the penalties for non-compliance? When you do not comply with this requirement for the payment of taxes or filing of your annual returns, what are the associated penalties? 1, a defaulting company shall pay 25,000 in the first month in which it failed to file its annual return, and 5,000 naira for each subsequent month in which the failure continues. So if my assessment or my annual return is due in June or on June 30th, if I fail to render my return on the 30th of June, then I am liable to the payment of penalty of what? Of 25,000 naira. That is the moment it is July 1st, then it is already late. So I'm liable to pay 25,000 naira for the first month of failure to render return. And if in July, I have not still rendered the return, from June, it will now be 5,000 naira every month for each of the months that the failure to file returns persist. Okay. We also have a punishment for any director or management of the organization that concealed or failed to what? Failed to render return on behalf of the company. What is the penalty? Any director that is associated with this kind of non-compliance is going to pay 100,000 naira or go to prison with an imprisonment of not more than 2 years. That is the penalty for not filing of returns, for not filing of return. 25,000 for each of the months that the company fails to render its return, and 5,000 naira subsequently for each other month in which the failure continues. Okay. Other returns. Apart from the return we have described above, what are other returns that some specialized companies are expected to render? Number 1, in addition to the tax return referred to, some returns are required to be filed. What are they? For banks, for instance, bank is required to submit to FRS within 7 days after the end of a month the name and the address of its new customers. So if you operate a banking business within 6 months of, within 7 days of the end of each month, you are expected to file the list of your new customers with the Federal Inland Revenue Service. Okay, your new customers. The list must be forwarded to the Federal Inland Revenue Service. Stockbroking firm. What about stockbroking firm? For companies that are trading on the floor of the Nigeria Stock Exchange, or NGX now, NGX, it is required within 7 days after the end of calendar month to file with the FRS a return for the preceding calendar month, which include transactions involving an offer in the primary market, which include type of offer, services rendered, amount of tax deducted at source, and amount of value added tax payable. Okay. So continue. Transactions involving operation in the secondary market, which include number and value of transactions carried out for relevant calendar month. All these are to be submitted to Federal Inland Revenue Service. Okay. Okay. Maintenance of book of account and penalty for failure to provide any record. So as a taxpayer, you are expected to keep a very accurate book of account. Okay. Your information should be well arranged in your file for easy retrieval. And accounting rules and regulation must be followed. Must be followed. Please. Okay, sorry, I was Okay, so sorry. I was trying to switch to another network. That's why it took me a bit longer to come back. Sorry about that. So let us continue. I hope the network is better now. So we're looking at the required to maintain appropriate book of accounts. And I'm telling you that all companies, whether or not you are exempted from the payment of income tax, you are expected to keep appropriate book of accounts that will be able to depict your underlying transactions. Okay. We have some companies that are given exemption from the payment of taxes by virtue of maybe you have pioneer legislation, pioneer status. If you have pioneer status, you are not paying tax for the next was it five years or so. But that does not exempt you from keeping appropriate book of record that will enable the revenue, that is FRS, to be able to determine your financial affairs at every point in time. Okay. So section 2 also requires that the book of account that the company will keep should be in English language. Okay. The return should be kept in English language. Then also section 3 of the Act requires that if the company has kept its record in a language other than the English language, then the revenue may require at its own instance the company to interpret that record into English language at the expense of the company. Okay, at the expense of the company. And section 4 requires that any company that fails to comply with these 3 subsections is liable or has committed an offense. And what are the associated penalties? Number 1 is payment of 100,000 in the first month for which the company fails to keep appropriate book of accounts. And after that first month, the company is going to be paying 50,000 naira for every subsequent month for which the failure to keep proper book continues. Okay. Subsection 5 also requires that when in the opening of the service, okay, a company fails or refuses to maintain book or record of account that are considered with the provision of subsection 1, 2, and 3, or are looking for the purpose of tax purpose, by notice in writing, okay, the commission can give by notice in writing, instruct such a company to what? To keep its book of account in such a way that the financial affair of that company can be ascertained as and when due, and prescribe the form in which the record is expected to be kept. Okay. And it can even go ahead and specify the language in which the record must be kept. So that is the power of the FRS on someone or on a company that fails to keep proper books of account. Now, any direction, that's subsection 6, any direction of the service made under subsection 5 shall be subject to objection and appeal in like manner as an assessment. So if the decision of the FRS on the fact that you have not kept a proper book of account is what you want to debate, is what you want to object. It is subject to the same objection procedure as though an assessment has been served upon that company. So we're going to see the process of appeal, that is appeal procedure. Appeal procedure. So you can appeal. You can appeal. So let's continue. Subsection 7 requires that any book or record required to be kept under this section shall be kept for a period of at least 6 years after the year of assessment in which the income relates. So it means that I'm in year 2022 now. My record for 2015, or let me say 2016, should be with me. So the one for 2015 is already long, but that does not mean that you should throw it away. You should just go and what, and archive it. Okay, just go and archive it. So you have to keep your record within a minimum of what? A minimum of six years. A minimum of 6 years. These are the requirements for registration and payment of taxes. Any question before we go to the next one? Assessment procedure. Assessment procedure. Yeah. Assessment procedure. Okay. Akindele, are you with us? If you are with us, say yes. If you are with us, say yes. All right. Okay. Olajumoke, okay. Akindele Olajumoke, all right. So let us continue. Let us continue. Now, assessment procedure. Assessment procedure. Assessment basically is defined as a process of determining the amount of tax that a taxpayer should pay. Okay, that is assessment procedure. It's the process of determining what is the appropriate amount that a company needs to pay. That's what we call assessment. I'm assessing you to tax, meaning that I'm computing your tax liability. I'm computing your tax obligation. So what are the assessment procedure? At the end of every financial year, or within 6 months, after the end of every financial year, a company must render a return. So before now, what used to be obtainable is the fact that government, let me say FRS, we go to each company at the end of each accounting year, at the end of the company's accounting year, to assess the company to tax, meaning that they go and check the account of the company and compute the amount of tax that the company should pay. However, that exercise is time consuming. The exercise is time consuming. Because of that, government now say, okay, instead of FRS computing the tax liability, can we give the taxpayer benefit of doubt and ask them to compute their own tax liability by themselves? So I'm assessing myself to tax. That is how self-assessment came into being. That is how self-assessment came into being. So government is giving us the right or the opportunity to compute our own tax liability. Okay, that is assessment. So when you are submitting your annual returns, it is expected that you submit it along with your annual returns that you have used to that you want to use to file your return. The amount of your tax due should be on your self-assessment form. Now, for self-assessment, you can apply for installmental payment of the tax due. You can say, oh, I want to pay this tax in 3 installments, but it cannot be more than 3 installments. Maximum of what? Maximum of 3 installments. And the condition, like I explained earlier, is that you must have made that application before the due date of filing. And the first payment must have been made along the application you are submitting for instrumental payment of tax. We call it payment on account. Okay, so 1 minute. We have the second assessment, which is what we call additional assessment. Additional assessment is the assessment that the revenue has computed, the tax that is computed, in addition to your tax liability as contained in the self-assessment that you file. For instance, my self-assessment can indicate that I'm liable to the payment of 5 million taxes. But upon review of my account by FRS, they can say, oh, come, your tax is more than 5 million. Your tax should be 7 million. That 2 million is an additional assessment. I did not fail to file my return. I did not fail to pay my tax. It's only that the amount I paid is less than the amount I should have paid. Okay, that is what we call additional assessment. Then, for additional assessment, the assessment is paid within 6 years after the end of the accounting year in which it relates. Then we have best of judgment assessment. Best of judgment assessment. Best of judgment assessment is an assessment that is made by the Federal Inland Revenue Service based on its own judgment of what your revenue should be. So when a company is not having an appropriate book of account and the revenue brings an amount, that amount is based on its own judgment. So what used to be obtainable is that in addition to the self-assessment, if the revenue discover that the tax you have paid is less than what you are supposed to pay, then an additional assessment is raised upon you. Okay? But if we are talking about based on judgment, you fail to render your return. You fail to render your return. So if you fail to render your return, the revenue can give you what you call based on judgment. How will the revenue give you based on judgment? They just inspect your bank statement and look at all the credit items in your bank statement, because when you make sales, you know, sales will be credited to your bank account, right? So all the credit items in your bank account will be taken as revenue when you are being assessed based on what? Best of judgment assessment. So what are the circumstances under which you get best of judgment? Number one, where a company files its return, audited account, and tax computation, the tax authority may refuse to accept the same if found unsatisfactory, and therefore proceed to determine the base of each judgment or base of judgment assessment. Now, I have computed my self-assessment, but when I presented it to the revenue, they rejected it on the basis that the amount I want to file is not the true reflection of my transaction for that period. So the company will go ahead and issue me best of judgment. Okay, they give me best of judgment. Number two, where a company has failed to submit self-assessment return, the one I mentioned earlier. So when you fail, the first one, you did not fail. You computed, but it was rejected on the fact that it is not accurate. But here, you did not even file it at all. So these two situations can give rise to base of judgment assessment. Then we have jeopardy/protective assessment. Jeopardy/protective assessment. For jeopardy assessment, it is available, it is an assessment made by FRS in a kind of urgent situations. A notable example is when a company is shutting down operation, a foreign company in Nigeria is shutting down operation in order to run back to its country. So before the company escapes to its country, what the revenue will do is that they calculate all outstanding tax liability of the company so that the company does not go with Nigerian money. That is jeopardy/protective assessment. If you do not want to pay this assessment, then it is expected that you file your self-assessment in the correct format. So maybe there is impending sales, or where a taxpayer wants to escape to foreign countries, or is intended remittance to foreign partners, or imminent liquidation of the company. All these may give rise to jeopardy or protective assessment. Then we have turnover assessment. Turnover assessment is also based on judgment, but in its own case, the basis of arriving at the tax is based on the judgment of the revenue with respect to your revenue income. That is turnover assessment. The assessment is computed based on your what? Based on your turnover. Based on your turnover. That is assessment based on turnover. Okay. Then we have assessment based on dividend. We have assessment based on dividend. Please note all these assessments and be able to explain them in 3-4 sentences. Okay. You are not expected to reproduce what is in the note, but ensure you are able to put down some things on this. When we say assessment based on dividend, sometimes the Federal Inland Revenue will assess a company based on the dividend the company pays in that particular year. So, for instance, where a dividend is paid out of profit on which no tax is paid. Let me give you an example. You know, when we say a company does not have tax to pay, it does not mean that the company makes a loss. The company can make a profit and there is no tax liability. Why? It's because of the structure. Okay? Because if you make a profit in a given year and you did not pay tax on that profit, only for you to declare dividend. You make a profit But according to your tax computation, you show a loss for that year, therefore no tax is paid. But later on, you now pay dividend out of that year's profit. That dividend you have paid will be regarded as the assessable profit. The dividend you paid will be regarded as the assessable profit. And you are going to be assessed based on that dividend. That's number one. Number two, assessable profit being less than the dividend paid. Your assessable profit in your tax computation is less than the amount of dividend you are paying. Take note. In that case, the revenue will take the dividend paid as the assessable profit. These are what we call dividend, what do you call it? Judgment based on dividend. Judgment based on dividend. Now, we also have dividend paid out of retained earnings. You have a retained earnings, and you are paying dividend from the retained earnings. That dividend you are paying will be taken as your assessable profit. But there are exceptions. What are the exceptions? Before the revenue will take the dividend paid out of retained earnings as your assessable profit, then the dividend are paid out of profit that has not been taxed. If you make a payment of dividend from retained earnings upon which you have not paid tax before, that dividend is going to be taken as the assessable profit, and you're going to pay tax accordingly. But if you have already paid taxes out of that profit, the dividend is no longer taxable. Okay? The dividend will not be taxable. Then, dividend paid out of all tax exempt income, pursuant to CGTA, PTA, and interest rate. Sorry. Subject to what? To tax under company income tax, CITA. Okay, no, I think I've jumped in. I've moved to the previous and we have explained this. This is where we are. So you pay dividend out of income that are not taxable. If you pay dividend from income that are not taxable, then that dividend is exempted from tax. For instance, you operate real estate. Real estate companies do not pay income tax. So if I'm paying dividend from that income, that dividend is not to be subjected to tax. Are we together? Distribution made by real estate company, I've explained that. All these are dividend exempted from taxes. Any other dividend outside what we have discussed here, the revenue will take it as your sales for that period. I don't know whether we have any question here. Let me take our question in the next 1 minute to be sure we are together. Any question? Question? Okay, let us continue. Back duty assessment. Back duty assessment is an assessment raised by on a company when a case of fraud is imminent, the revenue perceive that there is a kind of fraud in this company that may have affected the tax paid in the previous year. So the revenue can go back to as far back as 6 years in order to compute a revised income tax liability. Hello, question? All right, let's continue. So for back duty, where the FRS perceive that there is a case of fraud, they can go back and what? And assess the company for as far back as 6 years. And there will be a case of fraud, maybe one of the senior management of that organization, the directors, have concealed some information which has led to a reduction in their tax liability in the past. So the revenue can go back to those years and raise back duty assessment. However, the tax means tax appeal tribunal in Benin zone restricted the power of the tax authority to assess taxpayer to back duty exercise where fraud, willful default, or negligence on the part of the taxpayer has been established by a tribunal or a court of competent jurisdiction. Okay, so this court restricted the power of the revenue to go and assess company to back duty assessment. Okay. Now, service of notice of assessment. The notice of assessment can be served whether by delivering physical copy to your office, by sending through fax, email, or any other means of delivery information. So the service or the Federal Inland Revenue Service is at liberty to determine the mode of communication it wants to employ in discharging notice of assessment. So it can be through mail, through whatsoever. Okay. And what will assessments contain? An assessment will contain amount of tax paid, the tax payable, and the name, the place at which such tax should be paid. So these three items is very essential on notice of assessment from the revenue. Let's continue. One minute, please. Okay. Final and conclusive assessment. When can we conclude that this assessment is final and conclusive? When can someone conclude that this assessment is what? Is final and conclusive? The network is really poor today. The network is very, very poor. The network is very, very poor. So sorry about that. So sorry. Apology, please. So an assessment is said to be final and conclusive. One, if no valid objection or appeal has been lodged. FRS sent me an assessment and I did not communicate my refusal of that assessment. It means I'm accepting it. So I have the freedom to object an assessment within 30 days in which the assessment has been served. I have 30 days, within 30 days to what? To appeal. If I fail to appeal within that 30 days, then the assessment is said to be final and conclusive. You have to go and pay the amount as stated in that document. Then another way that we make an assessment to be final and conclusive is if the amount of total profit has been agreed by the taxpayer. You have agreed with the tax authority. The moment you have come into agreement, the assessment is final and conclusive. And the last one, which is number 3, is that the tax appeal tribunal has been able to adjudicate between the two of you and has given its own position with respect to that assessment. So if you appeal and the tax appeal tribunal look at your case and say, no, this tax should be reduced, then it means the assessment is not yet final and conclusive. But the moment the case has been decided, then the assessment is said to be final and what? And conclusive. Then the other one is just telling you point of the, okay, let me just give it to you. The amount of total profit has been determined on appeal. Now, we have a tax appeal tribunal. Let me explain to you. We have a tax appeal tribunal. The tax appeal tribunal is like the high court, but its own function is to settle tax matters, not criminal matters. I'm coming on. One minute, please. You have not gotten there. One minute, I'm trying to look at. Okay, I think we have passed this stage. I've passed this stage. We have discussed self-assessment. Okay. I think, did I pass this or I jumped it? Did I jump it? Or we have not gotten to, I don't think we have gotten to this place. I don't think so. We have not gotten to that place. I've not discussed self-assessment with you. Okay, so this is where we are. So these are the 3 things that will make an assessment to be final and what? And conclusive. What are they? 1, no valid objection has been raised by the taxpayer. 2, the amount of tax has been agreed upon. 3, the amount of total profit has been determined on appeal. These are the 3 that will make an assessment to be final and conclusive. It's a very, very popular question. Okay. Mention, or they can tell you when is an assessment said to be final and conclusive. So these are the 3 things the examiner wants you to mention. Okay. Now let's go to collection procedure. Can we finish it? We can't finish the collection procedure. Okay. I think we're going to stop here. Let me take your question before we round up. I think we just know that we have a collection procedure. We have treated a return assessment. So we are left with collection procedure. After that collection procedure, then we now go to the question and answer session. Yeah, we go to the session, the question and answer session. So it's not what we are going to end today. So let me take your question in the next 1 to 2 minutes before we call it a day. Yes? Question. If I'm not asking question, you have not asked one question today. What happened? No question? Okay, in the absence of question, can we call it a day on this platform? I'm going to meet next week and we conclude the collection procedure, enforcement procedure, and we're going to solve questions on this. Okay, thank you. Thank you, Daniel. Thank you. Thank you. So, thank you for being with me for tonight's class. Do have a very wonderful night rest. My host.
Yes, I'm with you, sir.
Yeah, you can end the class now.
Okay, sir.